Good morning, and thank you all for joining. Really appreciate you being here. My name is Kevin Melchiori, and I'm the co-founder and managing partner here at Tenet Wealth Partners. I'm joined today by my partners, Kyle Wetters and Daly Anderson. We're all certified financial planners and worked together for a number of years, both together and with clients, and really passionate about what we do. For those of you that are unfamiliar with Tenet Wealth Partners, we are an independent fiduciary financial planning and wealth management firm, just based here in downtown Champaign, Illinois. And as we mentioned in our invite email, one of our specializations is actually working with physicians, and in fact, we do employ a lot of tailored strategies to target the specific needs and challenges that you may face as a physician on the financial front, really at any stage. So we really appreciate you taking time out of your busy schedule to be here today to talk about a really important topic, which is ways to save and mitigate your tax impact that you face as a physician. Tax efficiency is a really big focus for us here as a firm, and an approach that we utilize here at Tenet in terms of tax efficient strategies. So our hope is you take a lot away from the presentation today and learn a lot in the process. So just before we get started here, just to go into the details, just a quick disclosure. This isn't to be constituted as any kind of tax or legal advice. It is really recommended that you consult with a tax preparer for any specific guidance that you would need from a tax mitigation or tax planning perspective. So we actually do coordinate with a lot of CPAs and tax preparers and attorneys also for clients. So we always recommend doing that. It's a good best practice as well. So just to kind of kick things off here, you as physicians do face a kind of a unique situation coming into the workforce where, you come out of residency or fellowship and pretty much automatically you're in one of the top three tax brackets. Most people, I would say, they go out into the professional world. They probably start somewhere in kind of beginning brackets or middle brackets that you're seeing here. And they kind of gradually work up towards a higher income and a higher tax liability. But for you, you're kind of thrown into the fire. It's great, you have a high income, but at the same time, what comes with that is a pretty high tax burden. And so we've just kind of highlighted the top three tax brackets, and it goes from 32% up to 37%. And by the way, this is not including Illinois. So when you include that in there, basically, 40, 45% of your income right there is taken away from taxes. So you definitely feel the burden, probably more so than most people that are out there. And that's on a year-to-year basis. But, just to put this into perspective from the long term, over the course of a really long career, you pay a lot in taxes. It's pretty staggering to look at that over the course of a 25, 30-year period. So what we're showing here in this chart is, let's assume 30 working years, salary starting at $250,000, all W-2 income, state of Illinois tax of 4.95%, and this also does assume no retirement plan contribution. So let's say you go throughout your career over 30 years, based on these assumptions, you're looking at almost $4.2 million in taxes paid, which is a pretty staggering number. And I mean, that's a really nice nest egg for retirement if you really think about it. But you're paying that in taxes. So if there's any way to mitigate or save on some of those taxes on an annual basis, that can also really add up. And it goes back in your pocket to use for other things, short-term goals, and then also long-term goals as well. So just wanted to show what the tax impact would be if you look at it over a longer time horizon as well. So just to kind of kick things off here, you as physicians do face a kind of a unique situation coming into the workforce where, you come out of residency or fellowship and pretty much automatically you're in one of the top three tax brackets. Most people, I would say, they go out into the professional world. They probably start somewhere in kind of beginning brackets or middle brackets that you're seeing here. And they kind of gradually work up towards a higher income and a higher tax liability. But for you, you're kind of thrown into the fire. It's great, you have a high income, but at the same time, what comes with that is a pretty high tax burden. And so we've just kind of highlighted the top three tax brackets, and it goes from 32% up to 37%. And by the way, this is not including Illinois. So when you include that in there, basically, 40, 45% of your income right there is taken away from taxes. So you definitely feel the burden, probably more so than most people that are are out there. And that's on a year-to-year basis, but, just to put this into perspective from the long term, um, you know, uh, over the course of a really long career, you pay a lot in taxes. And it's pretty staggering to look at that over the course of a 25, 30-year period. So what we're showing here in this chart is, let's assume 30 working years, salary starting at 250,000, all W-2 income, state of Illinois tax of 4.95%. And this also does assume no retirement plan contribution. So let's say you go throughout your career over 30 years, based on these assumptions, you're looking at almost $4.2 million in taxes paid, which is a pretty staggering number. And I mean, that's a really nice nest egg for retirement if you really think about it. But you're paying that in taxes. So, if there's any way to mitigate or save on some of those taxes on an annual basis, that can also really add up. And it goes back in your pocket to use for other things, short-term goals, and then also long-term goals as well. So just wanted to show what the tax impact would be if you look at it over a longer time horizon. Going to the next slide here too, and just not to belabor the point too much, but if you think about the fact that your high income also eliminates opportunities to take deductions and credits that most people have when they are in their career at some point. So that's pretty much eliminated. Also, the ability to contribute directly to an IRA or a Roth IRA. Those options are also either very limited or eliminated completely. So, like I said, I think you as physicians, you have a lot of difficulties from a tax perspective, more so than most. So we just kind of wanted to set the baseline, although you're experiencing it firsthand on your end as it is. So. Just to cover quickly the 5 areas that we're going to focus on today, the first being ways to save on a tax advantage basis, the second being tax efficient investment strategies. On the third point, we're going to talk about some ways to plan from an income tax perspective. And then the fourth topic is going to be covered by Kyle Wetters, and he's going to talk about ways to retire tax efficiently. And then the last topic we're going to cover is going to be covered by Daly Anderson, which is ways to plan your estate or your legacy in a very tax efficient manner. So a lot of good topics that we're going to talk about today. So jumping ahead into just different tax advantage savings options. So we're just going to start with the basics here. We're not going to get too much into the details, but these are options from a savings perspective that you're either accustomed to or have heard of or are using today. So 401ks, 403bs, those are very similar, where you can put money away pre-tax, money grows tax deferred. You can save up to $20,500. If you're a self-employed individual, business owner, a lot of people use a SEP IRA or simple IRA. So both really, really great ways to not only save for retirement, but also save on income taxes at the same time, because all the money that goes in is removed from your taxable income. So that can really add up over the years and help, reduce the amount of taxes that you'll pay on your income. And then, of course, we have personal retirement accounts like IRAs and Roth IRAs. Of course, the maximums that you can do in there are a lot lower. And like I said before, ways for you to contribute directly to these accounts is very limited. But with that being said, what we're going to cover on the next slide is another way to get money into a Roth IRA. So jumping into that, if you're looking at some just kind of more advanced options, if you will, a lot of plans now offer Roth options within their 401k and 403b plans. So you can kind of think of it as another bucket where you would put after-tax money in. So you're not actually saving on money going into the plan, but the money grows tax-free. So as long as the money is in the plan, it grows free of tax. And then at some point, you can roll that to a Roth IRA, and all future distributions are also tax-free. So contribution limits are also higher for these, obviously, because they're within a employer plan, so up to $20,500 there. So that's another great way to save on future taxes when you're thinking about retirement distributions. I mentioned Roth IRAs and the inability to contribute directly. And some of you may have heard of this strategy called a backdoor Roth IRA. Basically, what you would do in this case, because you're a high earner, is you would contribute to a traditional IRA via a non-deductible contribution, and then pretty much immediately convert that cash over to a Roth IRA. And since you're doing a non-deductible contribution and there's no growth because you're leaving it in cash and converting it, all that money gets moved over without tax. So if you think about doing that over the course of 20, 30 years, that Roth IRA bucket can really add up and save you on future tax dollars. There is something to be mindful of. I'm not going to get into the weeds here on this, but it's called the pro rata rule. And just to keep it simple, the ideal situation to do this is to not have pre-tax money currently in another traditional IRA, but that's something that we can actually help out with specifically. And just these last two options here, pretty limited in terms of the ability for most people to have these, but a mega backdoor Roth IRA is basically another version of a backdoor Roth IRA, but you'd actually use your 401k plan potentially to do this. The two things that you need here is the ability to do after-tax contributions, which is not the same as Roth, but then also for your plan to allow in-service distribution. So not going to go into that one too much, but that's another way to save up to $40,500 extra on a tax-deferred basis. And then the last one, a cash balance plan. This is more for self-employed. If you're a self-employed physician or provider, this is a great way to save anywhere from $100,000 to $300,000 actually into another plan. Again, like I said, it's best for private practices. So, and it's actually pretty complex. So that's something that we would work on an individual basis. But a lot of great ways to save from a retirement savings perspective. The other one too to cover is a health savings account. So quick disclaimer here is that you actually do need a high deductible health plan in order to contribute to these. But an HSA is what we call triple tax advantage. So when you contribute, the money's going in pre-tax, you pay no tax on the earnings, and then if you use those funds for qualified medical costs, you can withdraw those funds tax-free. So those are kind of the three ways that make it triple tax advantage. And this chart just shows that you can really save a lot, by way of tax deductions through a 15-year period. So this shows that you can save up to $36,000 in tax deductions. And then your tax deferred earnings here is close to $81,000, which leads to a balance of about $229,000 starting from zero over a 15-year period. So if you think about that, that's a lot of money that can be used not just for healthcare costs, but once you hit age 65, you can actually withdraw that money for anything penalty free. So at that point, at age 65, it's kind of like having another IRA. So we kind of refer to these HSAs as almost a healthcare IRA because you can use it before age 65 for health expenses, or you can use it after age 65 really for anything. So HSA is a really great vehicle to use. Just some other tax advantage savings options to cover here. 529 college savings plans if you have kids or grandkids. Contributions grow tax deferred, and then any distributions for qualified college expenses, those are tax free. But the other lesser known tax advantage of these is for the state of Illinois, if you use Bright Start or Bright Directions, you get a tax deduction up to $10,000 of contributions that you make on a single basis, or if you're married filing jointly, you can combine or double that and deduct up to $20,000. So that's a really nice way to reduce that 5% on income that you're paying on tax at the state level. 457 plans, these are non-qualified deferred comp plans. There's hospital systems here in town that utilize these and make these available. Work very similar to a 401k. The other nice thing with these is that if your employer offers both a 401k and 457, you can actually contribute up to $20,500 into both, which essentially doubles your maximum. So if you think about that, that's $41,000 that you could stock away in a very tax advantaged way. And then the third and final, and these are gaining a lot more popularity right now, are Treasury savings bonds or I-bonds. These actually have an inflation factor that increases their rate. So right now they're paying over 7.1%. And then that's going to reset here coming up in April. So while inflation is high, this is another way to save on a tax deferred basis. And the other thing with these too is the interest is actually exempt from state taxation. And then that tax can be deferred until you either cash the bonds in or until they mature. So that's another lesser known one that's gaining a lot of popularity right now, especially with all the inflation that we're seeing. So we're going to jump ahead here to just ways to invest tax efficiently. So obviously we've talked a lot about retirement accounts, and anytime money's in there, it's shielded from tax, which is nice. But what if you have a brokerage account or a trust account or a joint account? There are different tax implications for investing in those. So just at the top here of this slide, you'll see just the various tax rates that you'd be faced with. So if you hold an investment for a year or longer and you sell that at a gain, that's considered a long-term capital gain. So for you as physicians in higher tax brackets, you'd be looking at a 20% capital gains rate plus another 3.8% for Medicare surtax. Qualified dividends also get that preferential long-term rate, so dividends from stocks and mutual funds and things like that. But then if you own bond funds, like taxable bond funds, or you sell an investment at a gain for less than a year time period, then the rate jumps up quite a bit, and it's actually based on your ordinary income tax bracket, or up to around 41%. So very important to be mindful of these tax impacts, because they can cause drag, not just in an individual year, but also over a longer time period. So this chart here just shows that over a 20-year time period, the difference between a pre-tax portfolio, which is this blue line, versus a portfolio that's taxed, which is the gray line. And these are big numbers, but you can see that there's a pretty big disparity, $3 million here. And if you think about that, if there's ways for you to invest tax efficiently, maybe you can save, $100,000 or maybe $200,000, $300,000, $400,000. And that just goes back into your portfolio to be reinvested for the long term and to use for other goals. So you can see how big of a tax drag the taxes can take on your investment portfolio. One of the strategies we use a lot here at Tenet is something called tax loss harvesting. And so this is a way that if you think about, all of those capital gains tax that you'd be faced with if you sold, well, tax loss harvesting is just like it sounds. You're basically gathering losses together or strategically selling securities at a loss that will help offset those capital gains. So using the example here on the left, let's say you've owned an investment for less than a year, so this is short-term capital gains, and you sell it and generate $20,000 in capital gains. Well, if you do nothing, you'll probably owe around $7,000, which is real money out of your pocket. But let's say there's investment B, another security in your portfolio that is trading at a loss, and you sell that position, and now you've generated a realized capital loss of $25,000. Well, 20,000 of that 25 is going to completely offset this 20,000 in gains that you just realized. So that saves you 7,000 right there. But then you have $5,000 left over, which you can also use to your advantage. So 3,000 of that is going to, you're going to take that as a capital loss deduction on your tax return and also help you reduce your taxable income. So that's calculated around $1,000 tax savings. And then the remaining 2,000, you can actually carry forward those losses to next year and really future years. So let's say you have gains next year, you can actually use that 2,000 to help offset that as well. So just this example alone, you're looking at potential tax savings of a little over $8,000. If you think about doing this on a year-to-year basis, you're talking about thousands of dollars that you can save and really put back in your pocket. You do have to be mindful of something called the wash sale rule. So basically, you can't go back into the security you sold within a 30-day period. It has to be something similar. That is a little bit complex, and we always recommend working with a professional just to make sure that you avoid that wash sale rule at all costs, because that would actually disallow the loss. This is asset location is another strategy that we use here, and this is a pretty custom and can be complex type of strategy. But the concept here is that if you're thinking about the different types of accounts that you have, whether it's 401k, IRA, Roth IRA, or brokerage, they all have different tax characteristics. And so do your investments that you use, whether it's the type of asset class, muni bonds or large cap stocks, or even just the security types themselves, whether you use mutual funds, stocks, exchange traded funds, so on and so forth. And so the concept here is to take the least tax efficient assets, put those into tax deferred or tax advantage accounts like IRAs, Roth IRAs, and then your more tax efficient assets, so individual stocks, ETFs, municipal bonds, you'd want to put those more in your brokerage or trust or any type of taxable account. Because right there, you're kind of shielding yourself for those things that are going to spit out things at your ordinary income tax rate. So commodities, high yield bonds, that's going to be your ordinary income tax rate, versus things that are trading at more preferential capital gains rates, like large cap stocks, ETFs, things like that. You'll want to have those in your brokerage account. So this is a good way to actually maximize your after-tax returns in your portfolio. But like I mentioned at the beginning, it is a very tailored, it's more of an art than a science. So you have to be just kind of careful because like large cap stocks and things like that, those are very growth oriented. So maybe you still have those in a Roth IRA, even though they are very tax efficient. So definitely recommend working with a professional to employ this strategy in a very tailored fashion to what you're looking to do. Just a few things here, ways to be a little bit more tax efficient. Now, the first one, you might be looking at that and saying, well, why would I harvest any gains? You just told me to harvest losses. Well, we've had a really good run up in the stock market over the last few years, minus 2022. So let's say you want to take some of those gains that you've held for a long time. You couldn't really do it over the past few years because you'd have a big tax bill. So this is actually a good time to consider taking some gains or harvesting gains, and then take some of those losses that you have in your portfolio to offset those. Really good time to consider that, especially with the market being down on 2022. Short-term versus long-term gains management. We covered in that first slide about the difference between the rates if you sold something in less than a year versus more than a year. So you can be more strategic there. And then the other thing too, from the security type perspective, you have to be mindful of what's called capital gain dividends that come in at the end of the year in more so in actively managed mutual funds. So these come in December. These are in addition to the quarterly dividends that mutual funds pay. And what happens is around December, a big capital gain will come in that you're not expecting. And when that happens, you're actually taxed on that as a capital gain, either short-term or long-term. Very hard to plan for these. So it's usually good to have these actively managed mutual funds in a retirement account, because then it really doesn't matter. Case in point, actually, this past year, the Vanguard Target Retirement Fund had some internal changes that actually ended up spitting out very, very large capital gain dividends. Most of those were held in 401ks, but if you held it in a brokerage account, you had kind of a big tax surprise this year. So definitely want to be careful of that. Then the last thing here is just, we always recommend, just like other advisors, rebalancing your investment accounts from time to time. But you don't want to auto rebalance in taxable accounts because obviously there's taxes due on those. So you want to be more strategic with those if you are going to plan on rebalancing a few, 2 to 4 times per year, because you still want those to align with your with your long-term goals, but you also want to be mindful of taxes at the same time. And then lastly here, this is a unique strategy that we do here in-house called direct indexing. It's gaining a lot of popularity right now in our industry. And it's basically like owning your own ETF or index fund. So the concept is the same in that you're tracking an index, for example, the S&P 500, except instead of owning shares of a fund, you actually own the shares of those stocks themselves. So we build portfolios of either 75 to 100 stocks, sometimes 100 to 150. And what's nice is that you have more flexibility, more customization at the security level, but it also gives you a lot more opportunities to tax loss harvest, like we just talked about. Because like, let's say the industrial sector is down. Well, you can actually take those losses strategically just in that section without disrupting your overall strategy of the fund. So a lot more tax advantages with these. Like I said, it's a very complex and kind of new strategy within the industry, but does provide a lot of tax efficiency. So moving into income tax planning here before we move to retirement. So like I said, a lot of you are probably getting paid via W-2 income, and W-2 makes it very hard to find ways to save on taxes. But one way to actually plan strategically is something called tax bracket management. So let's look at the 35% tax bracket here shown. Let's say you are, right at the $530,000 level, or getting close to 540 as a single doctor. Some of those mutual fund capital gains, or maybe you have a higher income tax year this year, might bump you up into the next 37% bracket. So let's say you have another 40,000 in income on top of the 540. Well, now that 40,000 is at 37%. So, maximizing savings to your 401k, using HSAs, maybe if you have any rental real estate properties and have losses to take there, that can actually keep you within the tax bracket you're at now. Or on the flip side, let's say you're at, 215,000. Well, if you do those types of tax saving strategies, maybe you can go down to the bracket lower and actually be at 32%. So tax bracket management is a great way to plan from an income tax perspective and hopefully save on taxes there. Looking at charitable giving, obviously there's a lot of great charities here locally in Champaign. On top of just the feel-good factor of giving to your charity that you support, there's also a lot of tax benefits. So the first one there listed, called bunching charitable contributions. Let's say you have a really big tax year, you know, very productive year, and you get a large bonus. Well, you're going to have to pay tax on that. So if you're already going to contribute to charity on an annual basis, let's say of $10,000, maybe you triple that or quadruple that and give $30,000 or $40,000 just in 1 year, because that will actually be able to be taken as a deduction all this year and maybe help offset some of that additional taxable income that you'll have. When you're in the retire or getting close to retirement years, age 70 and a half or later, any money that you take from your IRA would be taxable unless you give it directly to charity. And those are called qualified charitable distributions. So that's a great way to give to charity and also reduce the taxable income that you face on those IRA distributions. And then the third and final here on the slide is donor advised funds. These are also gaining a lot of popularity right now. Similar in concept to a private foundation, except instead of forming your own entity, it's actually a personalized charitable investment account held with a sponsoring organization that's also a public charity. So, you know, you can name it whatever you want. You can call it, you know, the Smith Family Charitable Fund. You can keep it in your family over the years, actually. But what's nice about these is that there's multiple tax benefits. When you give to a donor advised fund, you get an immediate charitable deduction on those funds, but then you don't have to give it out right away. You can pick different charities each year. You can give or grant amounts at different amounts every single year. So there's no requirement to distribute a certain amount each year. So there's a ton of flexibility. And then as long as the money is in that account, it grows tax-free. And then also you can sell securities at a gain with no tax. So these work really well. For example, if you have highly appreciated stock or mutual funds, you can give those directly. And if you sold those outside of a donor advised fund, you'd pay tax. But once they're in the donor advised fund themselves, there's no tax whatsoever. So really great charitable entity that some people are familiar with now, but still gaining a lot of traction out there. And then lastly here, just talking about real estate investment. So really the key one I want to focus on here is something called real estate professional status, or REPS. So we have a lot of physician clients that have rental real estate properties, whether it's just one or maybe they have 5 to 6. And what this status is anybody can claim it. It's just a designation. You don't have to be a real estate agent. And what you do is once you have this status, you can actually use passive real estate losses to offset your active or earned income from your W-2. Usually you can't do that. The 2 main qualifications here is that more than 50% of your business or trade time has to be spent on real property trade, and then you have to perform over 750 hours of services just on real property trades throughout the year. So you might be looking at that and saying, well, hey, you know, I'm a physician, I work full time. This actually works great if you have rental properties, and let's say you have a spouse that's either part-time or not working at all, and their goal is to help manage these properties. They can actually just claim to be, you know, have rep status, and you can continue to working, and you can still take advantage of this. So this is a very little-known strategy out there, but it is useful. We do recommend, of course, like we said at the onset, working with a CPA to figure out if you can qualify. But if you can save pretty significant tax dollars by using this status. So talked a lot about you know, ways to save and kind of accumulate, but now we're going to pass it over to my colleague Kyle Weddis here to talk about ways to retire tax efficiently.
Hey, thanks, Kevin. Appreciate it. Great job on your sections there. So you know, really early in the presentation, Kevin spent time walking through different account types that you have access to in building your wealth. And Kevin, you can move to the next slide. That'd be great. So while you're working and saving towards retirement, you know, we describe this as your accumulation phase of life. It's obviously important to accumulate enough assets to support your desired lifestyle in retirement, but it's equally important to thoughtfully approach how those assets are being accumulated. You know, in this part of the presentation, I'll be focusing more on that distribution phase of life. But just wanted to highlight diversification of account types in this accumulation phase to really stress the importance of this in preparing to draw down your assets in retirement. So I'm sure everyone's heard about the importance of diversification. That really every advisor really pounds that drum. But having choices in account types too to draw from is going to be very important. Having the flexibility to draw from accounts that are taxed differently leads to the ability to use your funds in a more tax efficient manner. So a thorough financial plan really will illustrate which accounts money should be taken from in a given year, taxable versus tax deferred versus tax free. However, if you haven't taken the time to plan before retirement, you're really going to be limited in your options that you have when you need to actually draw on the funds. So moving on to the distribution phase, it's important to consider your entire financial situation, all income sources and assets when determining the most tax efficient approach to take in meeting your needs. Your strategy for withdrawing retirement assets is really as important as your strategy for accumulating them. A customized tax efficient distribution strategy can really save you significant value, and we'll take a look at that in a little bit here, and really extend the time horizon of your retirement assets as well. So, looking at income streams, that's going to include Social Security, pensions, maybe, even though those are really kind of going by the wayside. You don't see those near as often, but it's still an important part if you do have that. There could be part-time work in retirement. Maybe you have real estate or other passive income. Drawing from your accounts in the most tax efficient way will really heavily be dictated by these cash flows that will likely change year to year, which we'll take a look at here next. So on the next slide, we'll take a deeper dive into this. A little too soon. Thanks, Kevin. But looking at the example on the next slide, we'll look at that next. But having a retirement cash flow plan in place to guide you through what you can expect year to year will provide great insight into which accounts are most tax efficient to draw from in a given year. This may be looking at ways to reduce your overall tax bill in one year, but also maybe looking at ways you could take even more income in a certain year. So an example would be, even though you may owe more tax now, there could be significant savings by not being in a higher tax bracket in the future, really trying to smooth out that tax bracket, tax liability over time. Required distributions that I have here next, this is one of those events that can really cause a significant spike in income at age 72. While there are some things you can do to mitigate the impact of this, it's really largely something you are forced into taking whether you need it or not. There can be a lot of planning done around this early on if you consider certain options that might be appropriate for your situation to minimize the impact of these. Roth conversions could be an example of that, or qualified charitable distributions. So those are going to be unique to everybody's situation. So everyone's solutions are going to be different as well. So charitable intent, this doesn't apply to everyone, obviously, but it is something that our clients do consider most of the time. So it's definitely a planning point we wanted to bring up. So because if it is important to you, there are a lot of techniques that can be used to provide tax efficiency. Some have already been discussed, and we just talked about required distributions. If you take a qualified charitable distribution from your IRA, not only does this help satisfy your required distribution amount for the year, any amount taken as a charitable distribution is not included in your taxable income for that year. So if you're not able to take itemized deductions with the standard deduction being so high, this is still a way to receive a tax benefit for that charitable giving. Not only did you receive a tax deduction for making the contribution to the IRA or 401k at the time, it's grown tax deferred, and then it comes out tax free when you give to charity. So I know Kevin mentioned this in regards to HSAs, but if this strategy is applicable to you, again, that's another way that can provide really that triple tax advantage situation. But if you can itemize, avoiding capital gains by donating appreciated stock, using a donor advised fund, bunching, the things that Kevin already mentioned, those are all good approaches as well. There's so many opportunities that taking the time to figure out what the best strategies are for you, that's really going to add a ton of value to you in retirement. I listed a few unknowns here. Are you okay if, is your financial situation okay if you live longer? Obviously, with advances in medical, that's something that's becoming a reality. How long are we going to project plans out for? Can you maintain your retirement spending goals even if the market has bad returns? I think we've seen this over the last couple of months. It just kind of gives people pause. Are we in a good shape to still meet our goals? And then the other thing that's rearing its ugly head right now too is inflation. Can you and your plan keep up with higher than expected expenses? I listed these items here just to highlight common things that make this distribution phase very difficult. Uncertainty around these items and others can significantly impact your retirement plan. So having a dynamic plan in place to be able to have the flexibility and adjust your strategies under various circumstances, that really gives our clients peace of mind to make sound decisions instead of being reactionary. Finally, on this slide here, looking at diversification again, I've already kind of harped on it a little bit, but diversification in account types, really what we're looking for there is just really that flexibility to adjust year to year, given different circumstances and as your plan calls for. Within investments, we're really looking to position yourself to be able to draw down on your accounts in really any market environment and still meet your retirement spending goals. Being proactive instead of reactive in that situation. And then, as Kevin mentioned earlier, asset location, holding assets in the most appropriate accounts for tax efficiency, and to match up best with your distribution strategy. Everybody's situation is different, so it's not going to be a one-size-fits-all approach. All of these nuances require planning in advance and considering everything together instead of just piece by piece. Looking at individual accounts on their own. So on this next slide here, looking at that graph, really what we wanted just to highlight here is how your situation can change over time. And mapping this out in advance really kind of gives you the ability to plan and prepare for certain events so that you can take advantage of certain situations. You can see there's going to be a big gap typically, between starting Social Security at age 70 and required distributions that start at age 72. Maybe fill that gap with retirement account distributions or Roth conversions. Really the idea here is to how can you maximize your income in a lower tax bracket and then really smooth and flatten out those higher taxable years in retirement. It really is kind of a misconception that your income will be going down in retirement. A lot of people building assets in traditional 401ks, are kind of surprised at what the required distributions and how that growth over time can, really kind of force you into higher tax bracket situations that you may not be expecting. If charitably inclined, maybe bunch multiple years worth of donations into a donor advised fund, in your last working years, those few years before you're, going to retire, taking advantage, getting that tax deduction while you're in a higher tax bracket and getting more bang for your buck versus, having that lower income, those first few years potentially of retirement. Or, in the later years, again, if you have charitable intent, utilizing those qualified charitable distributions so you don't have to have those required distributions of your IRAs included in your income. So, it's really just, kind of the last point here, your strategic withdrawal strategy in retirement is really going to be critical to managing that tax impact, and that can have a big impact on your time horizon and how long your retirement assets last. My final slide here, looking at that top chart, just examples of how different tax and withdrawal strategies can have an impact over a 30-year time period. Again, not that these are applicable to everybody, but it really just highlights the fact that, being thoughtful and having flexibility in your retirement can, really significantly impact the amount of assets that you have left over in this chart here after a 30-year time period. Just making sure that you're withdrawing from the right accounts first makes a huge difference, and then layering in these strategies that might be applicable to you will just add to that benefit. In the bottom chart here, again, Roth conversions may not be appropriate for everyone. Just using it as an example of not only how you can strategize to make your own retirement more tax efficient, but it gives you a chance to look at what an impact an inheritance could have on your heirs. If leaving a legacy is important to you, Daly's going to talk more about this here in a little bit, so I don't want to steal all of her thunder, but really it could significantly change the way you approach certain aspects of your own retirement. As you can see in this example, there are significant assets built up by the end of this retirement. What assets do you leave to charity or heirs? A good example of this is the new inherited IRA rules. A non-spouse beneficiary has to withdraw all the assets out of the account within 10 years of inheriting it. So if that person inherits a traditional IRA, that could add significant tax burden to their situation. But if it's inherited through a Roth IRA, there's the same distribution rules, but it's not taxable to them. So just things to think through as you're looking at not just your plan, but how it can have an impact on your future generations too. So transitioning from having an income and saving money to draw down on your savings is a huge adjustment. Planning for that transition really needs to start years in advance of that change to allow you to be as tax efficient as possible in retirement. So that being said, I will go ahead and pass it on to Daly.
Thanks so much, Kyle. That was a perfect segue to estate planning and shielding your legacy. But before we get started on the deep dive of tax-efficient estate planning, just a couple of things I wanted to cover before we dive right in. And the first is that I never want to assume that individuals and families who I work with have a solid estate plan. In fact, I have found just through experience that estate planning is often one of the most common weaknesses in many people's financial planning lives. And so before I dive in, I do want to just address a few very common mistakes that I see, again, before I dive right in. The first one is not having any estate plan at all. So maybe not having a will, not having powers of attorney, certainly not having anything more sophisticated than that, maybe not even having beneficiaries established on retirement plans and life insurance. This is more common, I would say, than many people might think. And, it's something that whether or not you have established what you might consider wealth, it is important to have an estate plan and a plan for what would happen to you if you became incapacitated or to pass away. This becomes especially important if you have any minor children, because the will does actually proclaim, who would be the guardian for those children. The second kind of shortcoming I often see in estate planning is maybe having an estate plan, a will, but it being quite out of date. That happens quite commonly when we're meeting with people who are kind of transitioning to retirement, getting kind of ready for retirement. We crack open that really old document and we see that, wow, that date coincides maybe with their marriage or maybe when they had their first child and has not been revisited since then. Life changes a million times as the years go by, and so do estate and tax laws. And I really believe that your estate plan is a really big component of your overall financial well-being. And so it is something that should be reviewed probably at a minimum every 5 years, and certainly as anything in your life changes or as big changes happen on the estate planning side. And then the final kind of common pitfall that we often see is families who go through the estate planning process but maybe don't complete all of the implementation. Estate planning can be a bit of work, a bit of effort. You get great documents prepared by an attorney, and then it's up to you to implement them. And so that might mean making sure that the beneficiary designations are correct on 401ks and IRAs and life insurance policies. It may mean changing the ownership or registration on various accounts. There's a lot of things that go into estate planning on that kind of the initial setup of your estate plan. And the more tax efficient or the more sophisticated your plan may be, the more maintenance it may require on a year-to-year basis. It may require annual gifting. It may require, really checking things and making sure you're funding things correctly. So that third one is really just making sure that the implementation is there. And I think that's really, all three of those points especially are really where having a great team of partners in place can really help support your situation and help you accomplish those financial goals and legacy goals that you have for your family. Because at the end of the day, that's what it's about. It's about your goals and your wishes. So without further ado, we'll head into those strategies. So the first thing, starting with just a definition of what estate planning is, essentially it's the process of growing, preserving, and transferring wealth. It's something that, estate planning documents plans for, incapacity. So if you were unable to make your own decisions, what would happen, who would step in, how that would go, as well as upon your passing, how you would want things set up. And typically, it's going to involve legal considerations, tax considerations, and ideally, it's going to be led by your personal values and objectives. Taxes and legal considerations are incredibly important, but we always want to make sure that we've got our personal values and objectives in there as well. Common goals include ensuring the wishes of the decedent are carried out. I think that's probably number one, is making sure it's something that it's guided by your intentions. The second is minimizing costs, and in this presentation, the costs that we're going to talk about are taxes. And the third one is maximizing the value that you're actually going to transfer of your legacy to your beneficiaries, possibly to charities. All right. So first, let's start off by talking about what the estate tax actually is. So there's something called the federal lifetime exemption amount. And basically, you can think of this as kind of a big bucket of money or an allowance that you are allowed to transfer to other people during your lifetime. And the 2022 estate exemption is just over $12 million. You can see there on the bottom left. Now, this is going to include both taxable gifts that are given throughout your lifetime, as well as any assets that are left after your passing. This number, $12 million, this is the highest really it's ever been. It increases annually with inflation, and at this current point in time, it is actually set to expire in 2025 and revert to an earlier number, which is about half this amount. There are a couple of nuances to understand about the gift and estate exemption. Number one, there is an unlimited charitable deduction. So for any assets that you have specifically bequested to charity upon your passing, those assets can kind of offset, your taxable estate. The second is there is an unlimited spousal deduction. So similar to charity, any assets that are going directly to a spouse receive an unlimited deduction on estate taxes. Now this is for U.S. citizen spouses only. And then finally, there is estate tax portability on the federal side. So that means that basically it allows the deceased spouse to transfer his or her own unused portion of the applicable exclusion amount to a surviving spouse. So if Dr. Smith doesn't use all of his lifetime exemption amount, it's possible to transfer some of that amount to the surviving spouse. Now, if your estate, your federal estate, is over that exemption amount and it's determined that you owe taxes, the highest federal gift and estate tax rate is 40%. So we are talking about a rather, high tax rate, all things considered. Now, if you're looking at this slide and looking at $12 million as your lifetime exclusion and thinking, wow, well, I'm married, so I may have double that, $24 million. And you're thinking, phew, I'm off the hook. Well, not necessarily. If you're a resident of Illinois, Illinois has its own estate tax, and that tax starts once assets reach $4 million. So it's a much smaller threshold, and Illinois also does not provide for estate tax portability. So many people who may not reach that federal estate tax level may be falling within the Illinois side. All right, ready for the next slide? Thank you. All right. So how do you stack up? How do you know if kind of your estate is heading into that threshold where you may need to be doing some more advanced planning? Well, the first thing that we do and that we kind of recommend clients do is to make a detailed listing of your assets and liabilities, kind of an inventory of your personal balance sheet. So right here is just a sample that I created for Dr. James and Dr. Elizabeth. And I've listed out assets that are titled in each one of their individual names, as you can see with those different columns. And then the joint/ROS, that's rights of survivorship, that column includes assets that are held jointly. And so, what we do in terms of looking at your gross taxable estate is we start with your personal balance sheets, and we take out, anything that's been like a completed gift. So typically like college savings plans, 529 college savings plans, those are typically completed gifts that probably would not be included in your estate. And then we divide any property that's jointly held, we divide that by what was contributed to those accounts, or if it's a married couple and it's a joint with rights of survivorship, typically that's 50%. And so in this case, if I'm calculating, how much is currently held in Dr. Elizabeth's gross estate, I come to a figure about $3.5 million. Now, again, we're thinking, woof, we're off the hook. Well, again, not quite, because we have to think about anything that's going to enter into our estate upon our passing. And life insurance policies that are owned by the decedent actually do flow through into that person's estate. And so if we imagine that Dr. Elizabeth and Dr. James each have, a $2 million policy each, well, that $3.5 million estate is now $5.5 million for Dr. Elizabeth. And now we're looking at, okay, maybe we should be doing some additional planning here. All right, ready for the next one? So one aspect, as Kyle brought up when we're thinking about retirement planning, is really having a diversification of accounts. And that actually comes to play as well with estate planning. Some accounts are very tax efficient for your heirs to receive, whereas some are less tax efficient, and they may be more beneficial for a charity if you have, legacy desires that are going to benefit others besides beneficiaries. So we're going to talk through about kind of the tax efficiency of some of these different accounts and what you can do about it as you're planning your estate. So I want to start by thinking of the characteristics of our beneficiaries. That might be, if we're starting out of who do I want to leave my legacy to, who and what? It may be children, it may be grandchildren, it may be friends. There also might be charities or, causes that you'd like to leave money to. And then from there, really thinking about how do I want to carve out that pie? How much do I want to leave to children or grandchildren, and what capacity? And then from there, I kind of recommend starting to look about each one of their characteristics. So for, human beneficiaries, we look at their ages, we look at their tax rates, we look at things that, preferences. For example, maybe you have, one of your kids really loves the vacation home in Florida, and they're likely to want to prefer that asset over the primary family home. So that's where preferences come in as well. And then the other distinction is really, are we looking at beneficiaries who are people or who are charities? So once we've kind of thought through those areas, we can take a look at our own personal balance sheet and really look at, okay, at the distribution of different types of taxable accounts. And I'll walk through and kind of give you some ideas of the taxability and kind of tax efficiency of gifting or donating different accounts to family members, beneficiaries, and charities. So we'll first start with Roth retirement, whether it's Roth 401k, Roth 403b, or Roth IRAs. Those assets are accumulating tax deferred and should be, withdrawn tax free. So these are great retirement assets to leave to beneficiaries who are possibly in a higher tax bracket, who would benefit from that tax-free distribution. As Kyle alluded earlier, there are new rules with retirement account distributions that if we're leaving it to a non-spouse beneficiary, typically those need to be distributed within 10 years. So that's the same case for Roth IRAs as it is for traditional IRAs. The second asset class we'll look at here is life insurance proceeds. As mentioned before, insurance proceeds, when the decedent's the owner, typically flow into the estate and are calculated part of the gross estate. But the proceeds themselves do not have income taxes. So that's another very tax efficient type of investment or asset to pass to beneficiaries who are in that higher tax bracket. Appreciated securities. So maybe having a taxable investment account where that's performed quite well, and you have very low basis stocks or low basis securities that you don't want to sell and incur the capital gains. Well, currently under the tax code, securities and stocks that are appreciated typically have what's called a step up at your date of passing, so that that basis is now hopefully stepped up to the new market value. So those can be tax efficient as well. And then we look at some other asset classes like qualified retirement accounts that are pre-tax and health savings accounts that are very, they're excellent tools and excellent vehicles during retirement years and accumulation years, but they are going to be taxable to beneficiaries as they receive them and take distributions. So pre-tax, traditional IRAs, 401ks, those can be really good opportunities to if you have charitable intentions, they can be good options for bequests to charity, because charities do not pay income taxes on those types of things. All right. So my final slide, I'm just going to talk through some very common estate planning strategies that we see and that can be beneficial, to kind of create or even to reduce the size of your estate. So the first one is taking advantage of the annual gift tax exclusion. So as I mentioned before, there is a lifetime exclusion amount that's about $12 million. That's an allowance you can kind of use for, throughout your life and at your passing. But there's also an annual gift tax exclusion that doesn't dip into that account. So individuals are allowed to give $16,000 per person, per beneficiary, I should say, every year to kind of an unlimited number of beneficiaries. And married spouses are allowed to actually split gifts. So they can give to the same beneficiary their $16,000 for a total of $32,000. So this is kind of an excellent opportunity for those who are climbing into that taxable estate, if they have goals to kind of provide benefit to the next generation or others, to gift some assets out of their estate. And so considering what types of assets to gift can also be an important element there, ones that maybe have growth potential to kind of remove that from the estate. And then also taking advantage of the unlimited marital deduction is a common strategy as well, to kind of equalize values between married spouses. Along those lines, qualified transfers are direct payments to medical and educational institutions that actually kind of bypass the annual gift tax exclusion. So if you have grandchildren and you're wanting to cover college education, for example, you can actually make a direct payment to that educational institution without using your annual gift tax exclusion. Also, tax-efficient charitable donation strategies have been referenced several times here. Having strategy during your working years, maybe using a strategy within your will or your trust to leave specific bequests to charity. Another one is Roth conversions. So prepaying income tax to do basically converting traditional retirement plans into Roth can allow the assets to grow in the Roth IRA tax-free and then be distributed out to beneficiaries that are potentially in that higher tax bracket. And then finally, our trusts. And trusts, there's numerous different options when it comes to trust planning. It can be very detailed, a lot to it, but there are definitely a lot of ways if you have specific desires and wishes, or if your estate plan is, and financial plan is quite sophisticated, we look at trust planning with attorneys to kind of be able to facilitate what's needed there, right? And I'm gonna hand it back here now to Kevin, who's going to close us out.
All right. Excuse me. Thank you, Daly. Appreciate that. Good work. So just kind of wrapping everything up here, obviously covered a lot of different topics, and, tax efficient planning is really, it's a personal thing. So, not all these strategies are going to apply to all of you. Some may be to a greater extent than others. But really the important thing, Daly referenced this on her balance sheet example from an estate planning perspective, is, putting everything together, looking at your overall financial picture. Where do you stand now? Where are all your savings at? Where are you at with debt? And where are you at towards your goals? Because the different tax advantage strategies that you would look at employing really, are towards those goals and the things that you want to do. So this is just a snapshot from our portal that we actually use with clients to both do financial planning and run projections, but also to let clients see their entire financial life in one page. So really recommend getting organized and seeing everything at a very high level before you start figuring out which tax efficient strategies to employ when and where. Like I mentioned before, tax efficient planning is a huge part of our approach and firm and philosophy. So we actually created a concept called Household Alpha, where it's basically us as advisors and as partners looking to add value to your overall household bottom line. So that's, saving on taxes. So you see tax minimization there. And so cost savings is another one. And then also risk mitigation, just finding ways to add more value to your situation. And really that's a huge goal of us as partners and fiduciaries, is really, trying to find ways for you to add value, not just today, but when you're thinking 20, 30, 40 years down the line towards those long-term goals. So that's a way that we can help as partners. So with that said, thanks again. Really appreciate your time. Appreciate you joining us today, carving out an hour. I know your schedules are very busy. So covered a lot today, like I said. Really hope it's been helpful. If you have any questions, please don't hesitate to reach out to us. All of our contact information is listed there. We're happy to help. Obviously, we do a lot of this for other physician clients, so we're happy to help you on an individual basis as well. So thank you once again. Take care and have a great weekend. Thank you.